Today we're looking at the Global X FANG Plus ETF listed on the Australian Stock Exchange. We'll go over the ETF fact sheet, including the management fee, the index the ETF tracks, dividend yield, payment frequency, and the fund's performance. FANG is an ETF provided by Global X, who own and operate the fund. Global X are the ones who own the underlying shares in each of the individual companies. So when we buy shares in the ETF, we buy from Global X, who continually issue new units in an open-end fund, and not the individual companies inside the ETF. FANG tracks the New York Stock Exchange FANG Plus Index, which invests in companies at the leading edge of next-generation technology that include many household names before fees. It offers low-cost targeted access to some of the largest technology companies in the world, working on the latest next-gen innovations. Its primary goal is capital growth with a small dividend income, and is also exposed to international currencies which can affect returns positively or negatively. It pays distributions, which are dividends from the ETF, semi-annually, with a current yield of 0%, providing no income at this point in time, but it has paid distributions in the past. It has a management expense ratio of 0.35% per year, so for every $100,000 invested, it will cost $350 per year in fees, and this is automatically subtracted from the ETF unit price, so you won't actually see any fee transactions being taken from your brokerage account. Since FANG tracks a technology index, the largest portion of the fund is in IT at 49%, followed by communication services at 30%, and consumer discretionary at 21%. The benefit of investing in international shares is their broad diversification across multiple industries and foreign currencies. The primary focus and returns from international shares come from capital gains whilst providing some dividend income. Since inception, FANG has had an average annualized return of 30.3%, which includes both capital growth and distributions. Past performance is no guarantee of future performance, but it's a good sign of improving business fundamentals, continually driving each individual stock higher within the ETF. With dividends reinvested, the cumulative return becomes much higher. Reinvesting these dividends creates a larger compounding effect, exponentially increasing our returns the longer we have our money in the fund. This is the sort of approach I take investing for the very long term, using ETFs, to one day live off the investment portfolio as passive income through dividends or selling down small parts of the position.